Hello, my name is Tiara Adela Putri. NPM 234111152.
My Class Management 23B.
The evolution of banks began in ancient times as trade developed and the need to manage financial transactions grew. Initially, banking systems were relatively simple and focused mainly on the storage of goods and precious metals. Over time, financial institutions evolved to meet the increasingly complex needs of society, expanding from merely providing storage to offering loans and payment services. In the 17th century, the first modern banks emerged in Europe, with the Bank of England, founded in 1694, becoming the first central bank. These early banks focused on issuing currency and providing loans to governments. As time went on, banking systems expanded and commercial banks emerged to serve the general public with products like savings accounts, deposits, and loans. Central banks began to play an important role in regulating monetary policy and ensuring the stability of the financial system. The Industrial Revolution in the 19th and 20th centuries significantly impacted the development of banking as the demand for financing businesses and industries grew. Banks began to focus more on financing these sectors, while investment banks emerged to support capital markets and corporate mergers and acquisitions. With technological advancements, banking systems became more modern, transitioning to electronic and digital banking, which allowed for more efficient and accessible online transactions. In general, there are various types of banks, each serving different functions and offering distinct services. Central banks are responsible for regulating monetary policy and ensuring the stability of a country's financial system. They control inflation, set interest rates, and supervise commercial banks. Examples include Bank Indonesia, the Federal Reserve in the U.S., and the European Central Bank. Commercial banks provide a wide range of services to the general public, such as savings accounts, credit, and payment services, and they aim to generate profit by serving both individuals and businesses. Examples include Bank Mandiri, Bank Rakyat Indonesia, BRI, and Citibank. Rural banks, BPRs, are smaller institutions focused on offering credit to individuals, particularly in rural areas or for small and medium-sized businesses. They aim to provide greater access to banking for populations that are underserved by larger banks. Investment banks focus on investment activities, such as corporate financing, issuing stocks and bonds, and supporting mergers and acquisitions. These banks help companies access capital markets and secure funding. Islamic banks operate according to Islamic law, avoiding interest, riba, and focusing on financing methods that comply with Sharia principles. They offer products like murabaha, mudharabah, and musyarakah, which are structured in ways that align with Islamic finance practices. Development banks are specialized institutions designed to finance development projects, often related to infrastructure, education, healthcare, and other societal needs. These banks often collaborate with governments and international institutions to fund large-scale projects. Overall, the evolution of banking reflects the changing needs of economies and societies, with various types of banks working together to provide financial services that support multiple sectors.